Hello, everyone. Thank you for tuning in to another episode of Our 2 Cents on Your Dollars. We have James Credo and myself, James Enriquez, here with you today. James, nice shirt.
Thank you.
You're welcome.
It's actually a performance shirt. Yeah.
Performance, you say?
Yeah. It doesn't require the person wearing it to have performance or perform anything, but I am wearing a performance shirt.
Okay.
Yeah.
What kind of performance?
Well, it could be anything. It could be in the office. I think you're wearing a running shirt.
I am.
Yeah.
It also helps me perform better in the office.
Oh, okay.
Yeah.
Tell me more.
In case you haven't figured it out, today we're going to talk about investment performance. And we're also going to talk about rates of return. We're also going to talk about different kinds of investment income and how they relate to performance. So, James.
Yeah.
Over the years, I've heard the question a lot, especially more lately with the run-up in the market.
Yes.
I've heard the question, James, I've had X return. Is that good?
Uh-huh.
How do you answer that question?
Man, you can go in so many directions because, in what we do is about reaching specific objectives like, having enough for education, having enough for retirement. So the very first thing we look at is what is the required rate of return to meet that objective? So here, we're not even talking about investments. And oftentimes, people don't even start with this, which is, how much do you have? And with how much you can contribute to that objective, right? Will you have enough in a number of years? And number one, do you actually need a rate of return? Or with what you're doing, is it actually just enough already for you to reach that goal? And so what we're trying to figure out is, with your situation and how much you're saving, what is the required return for you to reach that objective? For example, if you get a rate of return of 1%, I know it's very low. Will you actually reach your objective? And then from there, you can have a discussion with the client. Well, Mr. and Mrs. Client, you're either you're going to be able to meet that objective, you're ahead or you're behind. And that's where you start determining where do you want to make the changes? Do you want to increase your savings? Do you want to increase the length or duration when you're going to reach that goal? Or do you want to take a little bit more risk and to increase the returns on your portfolio to reach that objective? So you could go in many directions.
Yeah. So have you ever gotten into a situation where it's like, yeah, your return is good, but you're not even meeting your required rate of return. You're not going to even meet your financial goals. So if that's the case, is it a good return?
That's a conversation that I love having, because this is where you can really show to the client that you really understand their situation and that you're providing a customized service. And to me, this is where you decide where do you want to make adjustments, because having a better return, right? If you feel like the return that you have is not meeting your objective, generally speaking, does require increasing the risk. And a client may not want to do that. So for me, if the return is good, but it's not meeting the objective, you have to do something about it. And you have to have an open dialogue about that. And as a practitioner, you have to be able to say, Mr. and Mrs. Client, their return is good, like you said, but we're not going to be able to get there. However, if we increase the risk a little bit, and in our case, that typically means increasing how much you have in stocks, it looks like you have a higher probability of reaching that objective, but this is what it's going to look like in different scenarios. Would you like to go that route? Or do you want to do something else first, like increasing the length of time to reach that objective? Or do you want to increase your contribution? Or do you want to do a combination?
Yeah. Yeah, I think what I found is that even if you increase the risk, you're hoping to increase your rate of return, but you can still fall short of the goal and have a subpar performance. So one of the things I like to tell people is, yeah, that's great that you got 12%, for example,
Right.
in your 100% stock portfolio, but did you know the comparable benchmark did 14%?
Right. Right.
So in that scenario, is it a good return or
Right.
is it not?
Right.
So what do you have those performance benchmarks that you focus on with clients, or how do you determine which is the proper benchmark?
Yeah, it depends on the holdings that they have. For example, if they're more of an aggressive client, aggressive means having the majority of their portfolio in stocks. We would typically use like the S&P as a benchmark. So it just really depends on how they're allocated. But you made a good point earlier. Just increasing your risk doesn't necessarily mean you're going to be able to reach that objective. And it's always easy to look at the charts, and this is where as a practitioner you really have to know your client.
Yeah.
Because it's so easy to look at the chart. Hey James, it looks like if I just increase my risk just a little bit, looks like my returns would be this number. But it requires for you to stay invested at all different market scenarios, like 2008 and like the pandemic, or staying invested. It's an election year when you don't like the party or the president, and so it's always easy to look at the chart, but you have to really also kind of know your client.
Yeah.
Yeah.
Surely you don't deal with this. Surely I'm the only one in the world that deals with this.
I have a feeling, yes.
So, okay.
Yeah.
I love what you said, right?
Right.
Required rate of return. Let's look at the goals.
Yeah.
But do you ever get a situation where a client says, or somebody just in general says, I don't need all that. I just want to get a really good return. I'm taken care of. I know I can meet all my goals.
Right.
I just want you to get the best return possible for me.
Yeah.
And if that's the case, then how do we evaluate how we're doing in those scenarios?
Yeah, if you're talking about a client completely comfortable, and they can take the risk, and they can go either direction. Yeah, if they want the maximum return, that's where you just go for the most part, 100% stock. And you ride it through all different scenarios. And I always try my best to articulate that there's no way around it. If you want a better return, generally speaking, you have to increase the risk of your portfolio, but there are no guarantees.
Yeah.
So what kind of conversations have you had with them regarding that?
Yeah, I mean, same types of conversations. But I was thinking about target rate of return.
Right.
So I know in theory it sounds like a good thing, but I don't think I've ever had anybody said, hey, I want X return.
Right.
But I like the concept of target rate of return,
Mm-hmm.
but not just looking at that target rate of return, also looking at the risk involved
Right.
to see if we're really comfortable with the types of investments that we would need to hit a required rate of return.
Right. Right.
So for example, if you tell me, my target rate of return is 9%,
Yeah.
and I show you that it has the potential to fall this much in this type of scenario,
Yeah.
and you say, no, I don't know about that.
Yeah. Yeah.
That's where I like target rate of return
Right.
and looking at the risk involved with that.
Right. Right.
Yeah.
Have your clients been receptive to that? How do they feel when you mention those kind of things to them?
Yeah, it's funny that you asked that because I just recently had a conversation where the person was speaking to another financial advisor.
Uh-huh.
The other financial advisor was boasting about their performance.
Right.
And this person intuitively said, well, that might not be apples to apples.
Right.
I don't know what that other person's situation is.
Right.
I don't know what their comfort level with risk.
Right.
I don't know if you just took all their money
Right.
or a small portion of it
Right.
and put it in this one investment, and that one investment did really good for a year.
Yeah.
So I think people intuitively understand these concepts.
Yeah, that's awesome that he was able to kind of figure that out on his own.
Yeah.
Yeah.
Yeah. So, okay, what is your favorite way of evaluating performance?
Um, are you talking about just specific to financial goals?
Well, I mean, just anybody in general. So let's say, you have a person that likes to do things on their own
Right.
and, they'll make a comment like that,
Yeah.
right? Like, hey, you know what? I'm doing fine
Yeah.
on my own. I got X rate of return.
Right.
Um, how do you like to help them determine if they really are doing fine?
Yeah, it was a bit surprising for me, especially during the pandemic, that that the people that took on stock trading, they weren't even benchmarking their performance. I thought that was very interesting. So, for example, benchmarking just means you're tracking or comparing the performance of your investments versus a benchmark like the S&P 500. The way I like to explain is the S&P 500 is made up of over 500 stocks, and that's a passive investment. And if you're trying to be more active through trading or picking specific investments, you have to be able to compare your performance versus a benchmark like the S&P. And so that's one of the ways I like to compare how clients are doing is to specific benchmark. For example, if you're buying mainly U.S. stocks, U.S. large stocks, you would compare it to the S&P. But there's benchmarks for if you're holding tech, energy. So you kind of have to be honest with yourself. How are you doing versus a passive strategy?
Yeah. Yeah, I think that's important. I think what's also important is you can't compare, let's say you have a 50-50 portfolio, 50% stocks, 50% bonds. You can't compare that portfolio to the S&P 500.
Right.
Because it's just not a fair comparison.
Yeah, it's not. I mean, one's 100% stock and one is, and half in bonds. Totally different risk profiles, so you have to be able to compare apples to apples, like you said.
Yeah. So how do you do that for somebody? So I assume you don't have very many people that are in 100% stocks. So how do you put together a benchmark for them?
Yeah, so our tools actually has the capability, depending on what asset classes that you're holding, to make recommended benchmarks. And it's still quite difficult to go apples to apples, but it seems like there's as many passive investments and benchmarks out there as actual investments. The difficulty is actually trying to get it as close as possible. But it's something that you can create. But it's still very difficult to get it 100% accurate.
Yeah. You mentioned stock trading in 2020 and comparing it to the benchmark. One of the things that I find fascinating is that there's plenty of literature that show that mutual fund managers, active funds,
right,
have a hard time consistently outperforming their index,
right,
over a long period of time.
Yes.
So my thought's always been, if those guys who the only thing they do is pour over spreadsheets,
right,
sometimes even talk to CEOs of companies,
right,
listen to earnings calls, and that's all they do. They don't deal with the end client. They don't help people tax plan, estate plan, figure out how much insurance they need.
Right.
What is to make me think that I'm going to do better than them?
You're different and you have a performance shirt on.
That's right. Doesn't help in just running, right?
I think they say that a lot of active managers actually outperform. It's just that when you include fees is the problem. So don't look here,
Right. Yeah.
So.
Okay. Well, to that point, fees, what about taxes?
Yeah, that's a big part of financial planning too. Sometimes, actually, a lot of times, that's often overlooked as part of your rate of return. But one of the things, if you're as an investor and you're looking at rate of return, you have to also look at the tax efficiency of your investments. It's awesome if you're making let's say 10%, But if you're doing a calculation and how much is going to taxes, it's down to 5, then you should have just taken less risk and taken a more tax efficient strategy.
So
Yeah.
it's not what you make, it's what you keep.
Oh, I like that. Yes. That's the name of another podcast that we have coming up.
Yeah, we've talked about this topic in another podcast, but I thought maybe we can go deeper here.
Yeah.
So what about yield investing versus total return? What does that mean?
Yeah, when I used to get that question, especially from clients, I didn't know how to answer it because I felt like if I answered it, I thought I would be kind of condescending a little bit. But over time, I was like, okay, I'm just gonna say I'm an advisor. I'm just gonna say what I think are facts, because that's what I'm paid to do. But because I didn't know quite what they were asking me, because based on the context of how they were asking it. But I think they were just asking me, what's the total rate of return? I think what happens is, whether it's through friends or from what they're reading or television, they keep hearing, this investment has a high yield. And so when they hear high yield, I think they're automatically thinking that's the total rate of return, versus actually yield is just it is a performance indicator, but it's a performance indicator of the income of an investment. And income means interest and dividends. So if you invest $100 into a specific investment and it's giving you a 5% income or $5, that's the yield. But in our field, when we're looking at investments, we're looking at total return. We're looking at the income and the price performance of that investment. And so, we try our best to educate clients. You have to kind of be careful what you're looking at, because typically when I get that question, I hear, "Hey James, I just heard about this investment. It's paying a 20% yield," and then I'm like, "Really? I want to invest in that too." Show me where you got that from. Which dinner? Which flyer? and then when you look at it, and then you see the amount of risk that you're taking to get that yield or income. But income is just one component. You have to also look at the price movement of that portfolio. It's one thing if you're getting, I'm exaggerating to make the point, it's one thing if you're getting a 20% yield from a investment, but the price of that investment is also down 20%, so you haven't made any money.
Right.
Yeah. And so that's something that, you have to look at as an investor, not just the yield. Because generally speaking, in our industry, if something has a higher yield, that typically means it's a higher risk strategy.
Yeah. I'm thinking of a situation where, you have stock ABC, it's yielding 6%.
Yes.
Oh, it's awesome.
Right.
It's great. It's better than what the bank is paying me.
Right.
But it's down 20%.
Yeah.
So your total return is negative.
Right.
And
Right.
it just always, I just think it's funny how some people are really concerned with that yield and neglect the price appreciation.
Yeah, and it's a question that we still get. So I know that it's much talked about, and it's something that I'm glad you brought it up, because we want to be able to specify to a client that it's one component. And actually, most investment firms, when they're reporting your total return, they're showing you how much you made from income. And then they're showing you if the price of that investment has gone up or gone down. So you can see the overall performance on your statements.
Yeah.
Yeah.
Okay, so we've all heard years and years and years ago, save up some money, invest money,
Yep.
then have so much saved up that you
Yep.
can just live off of the yield.
Right.
Are you finding that to be true in today's environment?
It's tougher because of inflation. However, I understand the concept, and also the concept makes it easier for investors and clients to kind of understand how you create a income source during retirement. But everyone talks about inflation now, rightfully so. Everything we're buying seems to be increasing in price every day. But based on my scale, it looks like in terms of food, the rate of inflation has not been high enough to stop me from my eating habits. So the Federal Reserve definitely has its work cut out. It's got anyway, but absolutely. Oh, sorry, lost my train of thought. What was the question again?
The question was, can you live off of just yield in today's environment?
It depends actually on client situation. This is going back to the required rate of return. Some clients have done a great job of saving for their future, that they can invest in a more conservative portfolio and live off a lower rate of return. And so I would say the answer is yes, depending on your situation. However, everybody's situation is different. How much you've saved up and your lifestyle is also different. Healthcare, your healthcare situation, your family situation, your gifting or giving situation is also different. So there are still cases where I can see where clients can live off just on the yield, but generally speaking, they have done a tremendous job of saving, and they're not needing as much rate of return to reach their income needs. Yeah.
Okay, so let's run through some quick math for just illustrative purposes.
Yes.
Okay, so let's say you have a 60% stock portfolio.
Yep.
40% bonds.
Right.
Let's say that stock side is yielding 2%.
Right.
So 60% times 2% is 1.2%.
Right.
Let's say that 40% bonds is yielding 5%.
Right.
So now you're at 2%.
Right.
So 2% plus the 1.2, you're at
Right.
3.2.
Right.
We've often heard the 4% rule.
Right.
So if you're drawing 4%, your
Yep.
yield is only 3.2,
Right.
you're living off more than just the yield.
That's right.
And so you're dipping into principal.
Right.
Okay. So how does that actually work? Like, are you selling investments to come up with that extra 0.8?
I see. You're talking about actually the operational side with dealing with clients?
Yeah.
Yeah.
And I'm asking you because
Yeah.
it's a question I've been asked by clients.
Right. Right.
And then, because then, furthering that train of thought,
Yeah.
it's like, okay, so if I'm selling something, first of all, I really don't like doing that because I don't want to dip into my principal.
Yeah.
But is it really principal if it's appreciated?
Right.
Okay. And then secondly, so what are the tax implications of doing that?
Yeah. So there's actually a lot more things that you consider when you're creating cash flow for a retired client. And where is it coming from? Is the client's money just all retirement money, like IRA money? Do they have some non-retirement accounts? So stepping back a little bit, when somebody is about to retire, we typically like to make sure that they already have 1 year's worth of reserves set aside before they retire, because you can't predict what markets will do. So we I guess to answer that question, we don't actually sell the needed return, right? We're actually selling actual investments to cover the cash flow. I don't know if that makes sense or if I'm saying it correctly.
It does.
And when you're selling investments, you have to consider the client's situation. You have to be aware of, you have to make sure that you have their tax returns, at least from the previous year. Do they have some carryover losses when you're thinking about in a year like 23 and 24, when investments have done very well and it's harder to find something where you can sell, there's not as much gain. So there's a lot of consideration. Yeah.
The carry forward, you're talking about capital losses from a previous year that you can carry forward into the current year to offset capital gains.
Yes.
Okay. Maybe we should spend some time talking about capital gain versus ordinary income.
Sure. Let's do it. You look excited to talk about this topic.
Oh, I love this topic.
Let's do it on a Friday afternoon. Let's go.
Well, we don't
You
know
can start.
You're watching this on whatever day you're watching
That's
this.
right.
So,
I meant.
so okay, capital gains.
Yeah.
Capital gains for non-qualified money.
Right.
So non-IRA money.
Right.
Okay.
By
Capital.
the way, when you say non-qualified, do your clients know what that means?
No, that's why I say non-IRA money. And there's so many terms for it. There's a brokerage account. There's taxable account.
Right.
There's non-qualified.
For years, I was like, yeah, you're non-qualified account. No? Okay. I need to do a better job.
That's why I say non-IRA money. I don't think it's a technical term. It's just something I say. So
You made it up.
right.
Yeah.
Yeah.
Okay, cool.
Maybe I should trademark that.
Yeah.
Okay. So non-IRA money.
Right.
Okay. So, well, let me back up.
Yeah.
Which one has a better chance of capital appreciation?
Mm-hmm.
Stocks or bonds?
Stocks, sir.
Okay.
Yeah.
So if it appreciates, I sell it, I am paying capital gains or ordinary income on that.
It depends on how long you've held it and in which account do you own it. Yes.
Say more, sir.
So if everything you have is in an IRA, every dollar that you take out of that IRA is taxable as ordinary income. If you have that investment in a non-qualified or non-IRA account, you can either pay ordinary income taxes or capital gains taxes if you're selling something at a gain. If you've sold something and you've held that investment for less than a year, then it will be subject to short-term capital gains. But if you held it for at least a year, then it would be long-term capital gains, and the rates could be lower.
Okay.
Yeah.
Yeah. And short-term capital gain property is taxed at ordinary income.
Yes.
So whatever tax bracket you're in at that time.
Right.
Okay. So in a non-qualified account, non-IRA accounts,
Right.
the capital gains taxes could be lower.
Could
Then
be
no.
could be zero,
Could be zero.
depending on your bracket. Do I have that right? I'm looking at you because I need.
Yeah.
Hey Jamie, can you pull up the Google?
Yeah. So I don't know. I don't have the. I probably should have looked it up before we got on here. If your taxable income is around $80,000 or less, then you could pay 0% on qualified dividends
Right.
or capital gains
Right.
or long-term capital gains.
Right.
And again, taxable income is after standard or itemized deductions.
Right.
So you could have a pretty high income
Right.
and experience 0% on long-term capital
That
gains.
sounds like it's not even fair.
It's not fair. It's like the one of the few bright spots in code.
Right. Right.
But yeah, so I mean that seems like we're giving up a huge benefit
Yep.
in the non-qualified account
Right.
by having stocks in an IRA
Right. Right.
because you're turning capital gain property into ordinary income.
Right.
So how do you put all that together?
Oh boy. There's a strategy that we like to implement called asset location, and when I talk about this, I'm all excited in front of a client. Hey, this is your rate of return, but we're also going to make sure that we do efficient tax planning because we see that as part of your rate of return. Like, yeah. That's cool. Thanks, James. But this is where you have to kind of step back a little bit and do what I call investment housekeeping. Okay, so if bonds, generally speaking, pay more income / yield / more interest and dividends, and those are subject to ordinary income taxes, which generally speaking are higher than capital gains. And this is where you're going to have to look at your portfolio and say, I'm going to try my very best to hold these investments in my tax deferred accounts, which are typically your IRA accounts. And then I'm going to put my stocks into my non-qualified or non-retirement accounts, because generally speaking, stocks pay a lower yield, and most of the return you get from stocks is from its price going up. And so if you don't sell a stock and it doesn't pay any dividends, like you said, you have this unfair but cool situation that you might not have to pay taxes on any of your gains, and that's something that a lot of people probably experienced last year and this year when stocks are up.
Yeah.
Yeah.
Okay. Why would I do that when I can just buy a municipal bond? Don't those pay tax exempt interest?
That's a good question, and that's actually part of the diversification. So to give some more clarity, we put your corporate and government bonds into your IRAs, and this, once again, we keep saying it depends, but it really does. But if you and the client have agreed that you're going to allocate your portfolio a specific way, and you need, let's say, 60% bonds, but you only have enough IRA money where you can put 40% of the bonds, so you still need 20% outside of your IRA. This is where you can consider having municipal bonds outside of the IRA, because the income, interest / dividends from municipal bonds are tax free. But the reason why you don't go, generally speaking, you don't go all the way municipal bonds is simply for diversification purposes. And so you really have, as a practitioner and as an investor, you really have to step back and analyze your situation. Yeah.
Yeah, I like what you said about your situation, because what I remind some people, depending on your situation, that tax exempt interest can actually subject you to other types of taxes or surcharges.
Right.
So, like, for example, tax exempt interest is considered for your Medicare premiums.
Uh-huh.
If you're already at that lucky age where you're on Medicare.
Yeah, because you're right. Because you just hear tax free, and you automatically think that's not considered for as income for anything else. But that's a very important situation.
Yeah, or even the other situation that not so many people are impacted by it now.
Right.
But pre-Tax Cuts and Jobs Act, there were more people subject to the alternative minimum tax, AMT.
Right.
And so private activity municipal bond interests can actually increase your AMT taxes.
Right.
So that's also what we point out to people. And we point that out because you can actually find municipal bond funds that are AMT free.
Right.
But then you get into, well, you have to compare that yield compared to a taxable yield,
right,
or even just a bond fund that is subject to AMT.
Right.
So just really knowing the situation and your specific tax situation is important.
Yeah. Here, if you're not reviewing your own tax situation, it's really key that you collaborate with your financial professionals, so that you have the entire picture and you're being proactive in it. And just like anything else, I think that's the most important thing to do, but also one of the most difficult things to do is staying proactive, because laws and policies always change, and so does your situation.
Yeah. Because AMT is going to come back stronger in 2026.
Whoa, what does that mean?
I'm sorry. That's another podcast topic. We'll talk about that some other day. Okay. A lot of our clients are high income earners, business owners.
Right.
So a lot of them are subject to the net investment income tax.
Right.
What are some things that you're doing to either minimize that or just address it? Or maybe you're not even addressing it at all. Maybe there's nothing you can do.
Right. It always goes back to going back to the basics, the foundation. And that investment income tax, what is it? Another, I think, 3.8%? Yep. On top of your capital gains tax. I believe for an individual, is it $200,000 and $250,000 for married?
Yes, married filing.
Jamie, can you confirm that? Thank you. So, back to basics. This is where you look at things that you can still implement. For example, are you contributing to your employer retirement plan, like your 401k, so you can reduce your income? Things like, are you putting money into a health savings account? So you have to look at different things to see if you can take advantage of strategies where you can reduce your income, especially if you're close to that threshold at 200 and 250, and implementing asset location, looking at, how much income is showing up on your tax return, is it as simple as putting your fixed income or bond strategy into your IRA account? So now it's all tax deferred and not showing as much on your tax return, and then you take it from there.
Yeah, and the reason why you would be doing all those things James talked about is because the 3.8% is taxed on the lesser of your net investment income or the amount of adjusted gross income in excess of those $200,000 and $250,000 thresholds he was talking about.
Right. Yeah, and it all adds up, and at least I think for us, we see that as part of your net rate of return. So
yeah. So again, to wrap it up, what James is saying, what we're both saying, is that we should look at the risk-adjusted net after-tax return to evaluate our performance. And when possible, you should determine what is the benchmark. Is it a required rate of return? Is it a target rate of return? Or is it just a benchmark return? And determining the appropriate benchmark is probably a good idea.
Right.
So you can either do this on your own or talk to your financial professional. An investment policy statement might help with this. We really appreciate you tuning in. Again, I'm James Enriquez. This is James Credo. That's our 2 cents on your dollars.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.